Welcome to Lesson 2. Hope you enjoyed the previous lesson. Welcome and remember to subscribe. Our Lesson 2, we are talking about accounting concepts and conventions. Let's start by definition of some terms. Our first term to define is principle. What is principle? Principle, these are rules or regulations that are followed in order to carry out the work properly. Rules are everywhere, they need to be followed. Other thing to define is accounting concept, and these are the rules and regulation of accounting. When you are making entry, when you are transferring, when you are balancing any accounting record, then we need to follow rules, and these we call them accounting concepts. Then we have accounting conventions. These are methods and procedures which are followed to give a true and fair view of the financial statement. We have another term, generally accepted accounting principles, and these are conventions, rules and procedures necessary to define accepted accounting practice at a particular time. Another definition that we need to check is International Financial Reporting Standard, which means international standard for accounting set by the International Accounting Standard Board. Let's go now straight to our accounting concepts and conventions. Starting with accounting concepts, we have separate business entity concept, we have money measurement concept, we have dual aspect concept, we have going concern concept, we have accounting period concept, we have cost concept, we have the margin concept, we have accrual concept, and finally we have realization concept. On the side of accounting conventions, we have convention of materiality, we have convention of conservatism, we have convention of consistency. Let's discuss this in details. Starting with accounting concepts, the first one is separate business entity concept. In accounting, we make distinction between business and the owner. All the books of account records day-to-day financial transactions from the viewpoint of the business rather than from that of the owner. We keep different records, and we don't consider owners when making these entries or business records. Another concept is money measurement concept. In accounting, only those business transactions are recorded which can be expressed in terms of money. Any non-money or that cannot be ascertained in terms of money, then it is not worth being recorded as a financial record. Another concept is dual aspect concept. Financial accounting records all the transactional events involving financial elements. Each of transaction requires two aspects to be recorded. This concept will lead us to what we call double entry concept. Double entry concept, we say whenever you have a debit, we'll have a credit entry. I will explain this later in the next lesson. Another concept is going concern concept. Accounting assumes that the business entity will continue to operate for a long time in the future unless there is a good evidence to the contrary. So the business is not to be liquidated soon, and it is bound to exist in the foreseeable future. The other concept is accounting period concept. This concept requires that the life of the business should be divided into appropriate segments for studying the financial results shown by the enterprise after each segment. Each segment could be determined maybe like a financial year, so that the life of a business can have different years which have different segments which have different financial reporting. Another concept is cost concept. Assets are recorded at their original purchase price, and this cost is the basis for all subsequent accounting for the business. So we record asset as per the cost, but not as per the book value. Another concept is the margin concept. Income made by the enterprise during a period can be measured only when the revenue earned during the period is compared with the expenditure incurred for earning that revenue. So we must compare the revenue and expenditure so that we can have a final what has been gained. So that is what we call margin concept. The one is accrual concept. Accrual concept make a distinction between the receipt of cash and the right to receive it, and the payment of cash and the legal obligation to pay it. We say that a transaction is recorded when it occurs and not when the money is received or paid. The other one is realization concept. Sales is considered to be made at the point when the property in goods passes to the buyer and becomes legally liable to pay. i.e., revenue is generally realized when goods are delivered or services are rendered. Let's go to the conventions. Accounting conventions, starting with the first convention of materiality. It states that items of small significance need not be given strict theoretical correct statement. So they are not really supposed to be recorded. The other is convention of conservatism, policy of anticipating possible future losses but not future gain. This is a safe way of recording, whereby you check on the loss and not the gain. First what can be, you can caution any loss that can be there. The one is convention of consistency. Once a certain procedure is adopted by the firm, it should continue with the same procedure for a long period of time. Changing can change many things in a transaction and can create misunderstanding. Thank you that you have listened to my tutorial. Now here you have some questions to check on, self-assessment questions. Read them. If you're able to answer them. And remember, we have many tutorials that we are preparing for you. Kindly subscribe so that once you have prepared anything to do with accounting, you are there to be the first person to receive it. Next lesson, we'll be talking about accounting process. Thank you for watching.